What is accounting? Why is accounting important? How should the financial statements be presented? What are the accounting standards? What are the accounting concepts and rules, like the matching principles? Hi everyone, welcome to my channel Accounting Masters. I'm Vic the CPA. In this channel, I'll be going through all the accounting basics and the accounting cycle of a company. Like double entry bookkeeping using debits and credits, preparing and analyzing financial statements correctly. People say accounting is boring, but it is not true, and I'm going to tell you why. I'm going to first briefly introduce accounting and the accounting rules. These are very important in building your foundation in accounting. We will also be applying them later on in our future videos. So what is accounting? Accounting has two elements. The first accounting element is bookkeeping, which is recording transactions as they occur to reflect the business. In bookkeeping, you will notice that there are two types of financial transactions, in which there is an exchange of money or items between two or more persons. Cash transactions, which is paid immediately. Credit transaction, paid on credit, which means that it will be paid on a later date. All proper financial transactions will have invoices and receipts for records to prove that they exist and for auditing purposes. Second accounting element is called financial accounting, where we summarize these up-to-date transactions and reporting them to the stakeholders through financial statements. These financial statements will reflect the past and the current financial performances of the company. Audit of the financial statements is required for all companies. There's also another type of accounting called management accounting, which are used mostly in goods producing businesses like manufacturing and agriculture to calculate their budgets and forecasts. When people say the word accounting, what they usually mean is financial accounting. So why is accounting important? Stakeholders such as directors, management level staff, investors and shareholders, bankers, lenders, customers, suppliers can make use of this accounting information like the financial statements for future decisions with the company. Investors will be one of the most frequent users of the financial statements as they will need to evaluate the company's financial health before investing their money into the business. Shareholders will be using the financial statements to see if the company is on track in meeting their expectations. Directors will be using the accounting financial information to pivot the company into a better direction. By using the financial statements, the directors can also see where the company's problems are so they can work on it and improve the company's future performance. Accounting managers will also use this financial information to perform company's forecasts and budgeting. Forecasts and budgeting are important for a company as it will ensure that the company is on track and is meeting shareholders' expectations. The budgeting and forecast figures will be updated and adjusted time to time depending on the current business environment. For bankers and lenders, they will use the financial statements to evaluate if the company has a lot of debts and poor repayment ability. If so, then the banks may not be able to lend money to them. Also, the suppliers will be demanding more of a faster repayment from them. So all financial statements and information should have the characteristics below. Relevance, clear and concise. All financial statements are relevant and presented clearly and helps the user of the financial statements to make decisions. Faithful representation. Complete and reliable. All information necessary to the user of the financial statements are there. Free from material error. Needs to be close to perfect. Neutral, free from bias. Can't be overstating profits or overstating assets. Comparability. Should be able to compare with other companies in the same sector. Measurability. Each item on the balance sheet and income statement are measured sufficiently depending on their nature. Timeliness. Should be provided to the users on time in order for the users to be capable to make their decisions. Delayed information will not be useful to the users of the financial statements. So, what are accounting standards? Financial statements are generally required by law and are prepared in accordance with legal and accounting requirements, called accounting standards. The financial statement for companies in the United States will follow the GAAP, Generally Accepted Accounting Principles. GAAP is a set of procedures and guidelines for companies to prepare their financial statements and accounting disclosures. The main purpose of GAAP standards is to ensure that the financial information provided to the users, like investors, banks, and regulators, is reliable, accurate, and consistent with one another. In other countries, they may be using IFRS, International Financial Reporting Standards. So depending what country the company needs to report in, they will need to follow and apply that country's accounting standards to the financial statements. Before we go into the types of accounts and balance sheet and income statements, you should know more about the accounting concepts in order for you to build the foundation to become the accounting master. So let's talk about accounting concepts, sometimes referred as accounting principles or accounting rules. One of the most important accounting principle is called the matching principle, also called the accruals concept. So what this is revenue earned during that period of time must be matched against the costs incurred during that period of time. For example, any revenue on the product sold must be also matched exactly to the cost of the product in an account called cost of goods sold. More on that topic in the later videos, so be sure to hit that subscribe button and notification bell. So say the company, smartphone retailer, sold a smartphone to a customer for $500. The sales of the $500 earned will also need to be matched to the cost of that smartphone purchased by the company, say around $400. That is called the matching principle. Duality concept means every business transactions will affect two items in the company's balance sheet or income statement. This duality concept will be applied to the double entry system, debits and credits, in bookkeeping and in all the transactions. You will see this double entry bookkeeping with debits and credits in my future video, so stay tuned. Consistency. The company's accounting policies must be consistently applied from period to period. For instance, if a company is using a type of depreciation method such as a straight line basis, which I'll cover in my later videos, then the company is suggested to use it in future years in order to have a better consistent measurement in each time period. Going concern rule. The financial statements assume that the business will continue in operating for the foreseeable future. Concerns need to be raised by the accountants in the financial statements if the company will be going bankrupt soon. Prudence concept. Accountants need to carefully make estimates of expenses and provisions so it does not understate profits and overstate costs. Entity rule. The company's books are separated from its owners' or shareholders' expenses. The owner's private expenses are not to be recorded in the company's account. Any money taken out from the company by the owner will be recorded as drawings, which is an equity account. Materiality rule states that the size of an item should be considered when applying to various accounting policies. For example, if the company bought a pack of stationery worth $10, the company wouldn't recognize it as an asset because the amount is so small, but the company will put it into an expense account. So we're not saying that you should ignore or not record items which are under a certain dollar amount, but the way that the items are recorded. Substance over form. Accounting transactions are treated with commercial substance and not in legal form. An example is a company car that is under a lease. Even though the ownership title has not been legally transferred to the company to become an asset, but in accounting terms, as the company has been using the car for most of its useful life and has been paying off the full price of the car with monthly repayments, so the car will belong to the company's assets. This is a lot of information to take in at first, but do not worry. I will fully apply them step by step in the future videos. You will see how these concepts link together when we prepare the financial statements. So be sure to click subscribe and click on the notification bell so you won't miss out any new videos. And if you found this video helpful, please click on the like button and leave a comment down below. And I'll see you in this video where we'll be talking about the 5 types of account in accounting you must know, which are assets, liabilities, equity, income, and expenses.